Welcome to ETF Edge, your go-to place for everything exchange-traded funds. I am your host, Bob Pisani, but you knew that, right? U.S. stocks are having another strong year, but it's a mixed picture outside of the United States. Europe is seeing small gains, and Japan is having a strong year, but the rest of Asia generally underperforming, particularly China. Here to discuss, Brendan Ahern, Chief Investment Officer at KraneShares, who manages the KraneShares China Internet ETF. That's KWEB, as we call it. And of course, we also have John Beatson, co-CIO and Managing Director at Sepio Capital. Brendan, I want to start with PDD, Pinduoduo, which the company is. It's one of your largest holdings. They had a big revenue miss today. I think it's down 30%. This is the parent of Temu, the fast fashion retailer. They compete very much with Uniqlo, with Zara, Shein, another Chinese fast fashion competitor. Fast fashion seems to be having a tough moment here, right?
Yeah, I mean, the company grew 86% for the quarter year over year, but that was a miss from analyst expectations. At the same time, really on the press release as well as on the management call, you had a very, very strong emphasis on increased competition within the space. Particularly that's weighing on JD and Alibaba today. The company is not going to do a buyback nor pay a dividend, as well as the company talked about investing in their own business, and that might actually jeopardize the profitability that the company had come to. So net, it was not a great read from management. The stock had been up about 70% over the last year relative to the space, its peers. So it's a bit of a crowded long, and I think it's paying for that at the moment.
Yeah, my sister loves them and buys $9 dresses from them. So they seem to be popular, and yet when you look at stores here in the United States that compete against them, Zara, they have stores here, and of course Temu doesn't. It's a pretty tough business to turn around. You're constantly turning over inventory, right?
Sure. It's and trying to navigate what consumers want and trying to get ahead of those trends. So again, the company's hyper growth and just that slight miss leads to a big drop today.
China, I want to just get broad thoughts from you. Notably underperforming so far this year. The Shanghai Composite is down 4% year to date. The Shenzhen Composite, which is tech-oriented, is down 18%. Hong Kong's only up 4%. And this is what the S&P up, 16% on the year. What is causing China's underperformance, and why is mainland China stocks particularly underperforming this year?
You have a very tepid economy in China where the government has not gone into strong fiscal policy to lift the economy. Export-driven manufacturing has been strong, and yet domestic consumption has been very, very light due to zero COVID, that kind of scar tissue, as well as a real estate crisis in China that's really weighed on the balance sheet of the household. So I think investors, particularly in mainland China, that Shanghai, Shenzhen, very much looking for much stronger fiscal support from the government. And thus far, we've been left waiting. Growth stocks in Hong Kong, like we hold in KWEB, have held up a bit better, and I think some of that's just money coming maybe out of significant outperformers like US tech, Japan, and India to buy some cheap China tech.
Now you run the China Internet ETF, KWEB as we like to call it. You've got $4.7 billion in assets under management. It's one of the bigger China ETFs out there. But even with some big names like Tencent up 30% this year, you're still down 6% this year. I know Pinduoduo is a big holding for you, might be 10%, but it seems all over the place. Even China tech stocks, in theory, should be doing well. Look, it's just all over the place. Here's your largest holdings, but Pinduoduo, PDD, is down big today.
Yeah. I mean, the companies have no AI premium given to them, unlike their U.S. equivalents.
Yeah, given how big, like Meituan or Alibaba or JD.com, you could do anything, on a message site with these people.
Baidu,
you'd think they'd own the world.
Yeah, exactly. I mean, they get no credit for that. And I think just stepping back, big picture, you have this incredible U.S. equity outperformance, and just a lot of things are really out of sight, out of mind, particularly China tech at the moment. But again, I think you need to see policy amplification, and then you'll see investors kind of come back into this space.
I want to bring a new contributor to ETF Edge. I'm very excited to chat with him. John Beatson is the co-CIO and the managing director at Sepio Capital. Sepio is among a very small group of financial managers. They not only manage money, they've started their own ETFs. Why I was interested in John. He also manages the Capital US Equity ETF. The symbol is SMRI, which began trading 10 months ago. It's a value fund. John, I want to talk about your ETF, but before we get to that, you've heard what we were talking about here with Brendan and I. Your thoughts on China as an investment in general, any other thoughts on emerging markets as well?
Yeah, on EM broadly, if you're focused as we are on risk management, the majority of the large passive EM ETFs have anywhere from 40 to 43% exposed to just China and Taiwan. So it's not our base case, but there is a probability greater than zero that there is a geopolitical event around China and Taiwan. Now, China, you could argue, has at least some of that risk priced in. The CAPE ratio for China is around 10 times. It's trading for 1.1 times book. So at the index level, you could argue it's fairly attractively valued. Taiwan, on the other hand, is trading for a CAPE of 29 times and 3.6 times book value. So arguably, that market, we would think, is not properly pricing in the risk that there is a geopolitical event around China.
Well, Brendan, get a response to that. I mean, he's got a good point here. There is political risk in we don't know what Xi Jinping is actually doing. He seems to be trying to get more control of the economy, so less capitalism. And then there's the Taiwan risk. As he pointed out, the market knows this, so this is to a certain extent priced in. This seems to be a factor in the underperformance, though.
Yeah, I think it is a factor. At the same time, U.S. investors are highly exposed to China implicitly through U.S. multinationals that generate a huge amount of revenue in China.
How much revenues does Apple get from
Apple's 16%, Tesla's about 25%, ExxonMobil 10%, and then Boeing, Nike, Starbucks. So again, you have a lot of, and there's no discount given to these U.S. names over the same risk. At the same time, I think what allows us to sleep at night is China's economy is so geared to the West that if you saw Russia has been ostracized from the global economy, from global financial markets, China can't take that risk. Their economy needs the West, and I think that's lessens the likelihood of a forcible takeover of Taiwan. Just they have everything to lose and nothing to gain in doing so.
Yeah, it's a good point. John, I want to talk about Sepio. You manage roughly $6 billion. Tell me a little bit about Sepio's management philosophy and how do you use ETFs in your business?
Sure. So Sepio is a multi-family advisory firm. We also have an investment management side of the house that includes our ETF that you mentioned earlier, SMRI. But generally speaking with ETFs, we're going to have very strong opinions about specific asset classes and markets around the world where we want exposure. And ETFs are a very tax efficient, a very liquid, and a very transparent way to express a specific investment view.
Yeah, so I noticed you converted, I think this was a separately managed account, right, into an ETF, what we're calling here the Bushido Capital US Equity ETF here. Is that right? You converted this into
That's exactly right. Yeah, starting in 2020, we had a separately managed account strategy for our advisory client base. And we were fortunate that strategy had done quite well. We wanted to broaden out the investor base as well as use the tax efficiency and the transparency and the liquidity associated with an ETF for both our clients and for a broader investor base.
Yeah, so we're putting up a full screen here, John. I'm sorry to interrupt here, but this is actively managed by you. It's 30 to 50 stocks. There's what we're calling a fundamental value approach. Tell us about what's in this, how you choose the stocks that's in it, what's going on with this one?
Yeah, so we would say that there's been quite a bit of storytelling that has crept into the U.S. equity market over the last decade, really post the GFC. And a lot of narratives around why a business or a company should do well, and very little attention to the boring process of actually doing valuation work and a lot of fundamental analysis. So there's a lot of attention today around valuations in AI names and related names being possibly elevated. But we would argue that we've seen some expensive valuations creep up in several segments of the market. You know, you've got Costco trading at 52 times forward earnings. JP Morgan, highest price to book valuation in 20 plus years. So we really wanted, in a systematic, repeatable way, to get exposure to quality companies, and we deem quality to be a prodigious amount of free cash flow generated relative to the capital employed by the business. And we wanted to align ourselves with senior management teams that were very shareholder friendly. So instead of diluting equity holders to grow the overall business, we wanted to be focused on management teams that were buying back stock when valuations looked attractive and or were also paying out dividends.
Yeah. Okay, good point there. And you can see what I find interesting here is, these are sort of classic value names. There's healthcare in here, there's Centene Healthcare, Cardinal Health, another value name, Lockheed Martin. That's kind of a surprise to me in terms of a value play, but nothing surprised me here. These are all about 2% because there's about 50 stocks in it, so that would make sense, right? I guess you're...
Yes,
all
that's exactly right. We're equal weighted.
Right, you're equal weighted, okay. I want to turn back to China for a minute, get some more thoughts from you on this, Brendan. So there was some recent news on Alibaba. We were talking about, at the end of last week, they had a shareholder vote to convert their New York Stock Exchange primary listing to a dual primary listing with Hong Kong and the New York Stock Exchange. Correct. This is a little confusing, but I want him to explain this. What is a dual primary listing, and why is that important for Alibaba? What happens here?
Well, now they're actually basically from a compliance regulatory, both the SEC and Hong Kong's SFC, so they have to adhere to both of these regulatory regimes. The positive is only primary Hong Kong or dual listings can actually get added to what's called Southbound Stock Connect, which is the trading venue that allows investors in China to buy stocks listed on the Hong Kong Stock Exchange. So today, you have its rival Tencent. 10% of its shares outstanding are held by investors in mainland China through Southbound Stock Connect. That's 10% of a $400 billion market cap company. For Alibaba, it's 0%, but that will definitively change very likely in early September. We don't know the exact date because of this movement from primary to a dual primary.
So if I'm a mainland China investor, I can't really buy into own Alibaba?
No.
That sounds so strange. I mean, the company is basically based in mainland China.
Yeah, all of the revenue.
All the revenues are mainland China. If I'm an average retail investor in mainland China, I can't own Alibaba right now?
Not until they get added to Southbound Stock Connect, which we anticipate within about 2 weeks, maybe even sooner.
That's remarkable. You know, you'd think like that would have been owned by retail investors in China by now, years ago. Yeah,
I mean, it's just think about not being able to own Amazon. And you're talking about a company that has hundreds of millions of users are being given access to buy it for the very first time.
Yeah. We have an election coming up. And both candidates seem to want to impose some sort of restriction on technology exports to China. How is this affecting China stocks? Is there some kind of play around the election or anything like that? What's your thoughts on that?
Well, we think that with either candidate, there's pros and cons. Obviously, President Trump during his administration did a deal with China. A lot of his rhetoric doesn't end up as actual policy. It's kind of the art of the deal, the negotiating. So I think something like 60% tariffs is just some of the pre-negotiating. At the same time, the Biden administration has been really tough on China in terms of export controls, something that you would assume Kamala Harris would continue. So, there's kind of pros and cons, but ultimately you're seeing more diplomatic. Jake Sullivan, National Security Advisor, headed to Beijing this week. So I just think the two sides talking more. The two sides went through a COVID divorce. There were COVID babies, but there were also COVID divorces. And hopefully the two sides work out, because for any investor, particularly U.S. investors, these great U.S. multinationals have so much to lose if you see a fraying of the economic relationship.
Yeah. So, John, I just want to get your final thoughts on this. What place does China have in an investor's portfolio? 10 years ago, we all used to think like, well, global, size of the global portfolio in terms of market cap. So if China was 6% of global market cap, you have ETFs that hold, global ETFs, they'll hold 6% China. And well, given the political risks that have emerged in the last few years, a lot of people are saying, well, maybe we should consider that as an issue. And maybe you shouldn't just invest on market cap. Maybe there are other concerns, like whether or not China's political situation warrants less exposure, or the political risk around Taiwan that you mentioned. Is there a place for China owning Chinese stocks in an international portfolio?
Yeah, I think there is a place. I think for us, any asset class, it comes down to valuation. We talked earlier about the fact that China arguably has many of their issues currently priced in to their equity market. So if you're going to remove allocations to countries based on political risk or general geopolitical risk, it's going to be tough to invest at all in EM broadly. So I think for us, it comes down to the risk reward profile. To what extent is the risk already priced in? I think China is at least partly there, and given the size of the economy relative to world GDP and the valuation, within your risk management confines, you probably want to maintain some exposure.
Yeah, I mean, that's a good point. I mean, I know global value people, they don't worry about political risk at all. And their only position is, okay, if a certain emerging market country is 14 times forward earnings, historically, I see, based on, it's almost like a technical / fundamental reading. It's completely divorced of political risk calculations. It's cheap now. I know at 14 times for whatever the numbers, I know value guys who will do this mechanically, then you do it there. Yeah. So there's different ways you can look at this. Percentage of global market capitalization, is it value or not? Or do you consider eliminating, and as John said, if you start eliminating stuff based on political risk, you're going to eliminate a lot of places in the world.
Sure. And ultimately China's 2.5% of all country world. I mean, that's relative to being a $18.5 trillion economy. So it's that kind of GDP to market cap. I mean, it's at such an extreme low relative to, say, the United States.
Why is it only 2.5%? It's 2.5% of market cap of the, say that again, I'm sorry.
So MSCI All Country World Index, China's 2.5%. I mean, actually, Canada was actually larger than China.
Do they include the full market cap of mainland China?
They don't. They've capped that. So that China would be about not quite twice that if you had the full inclusion of the Shanghai, Shenzhen names.
And why do they not include the full market capitalization?
They had historically, due to a lack of access, that has been changed, but I think because of the trade war, tech war, the geopolitical, that inclusion has been stopped.
Yeah, it's been a tough situation for them. Yeah. Well, even at 5%, given China's heft in the global economy, it's still a rather small number. I mean, the United States is close to 60% of global stock market capitalization.
I mean, this Friday you have this big MSCI rebalance, one of the largest trading events of the year. And, India is increasing to 20%, even though its GDP is about $3.5 trillion. China is at 24% of MSCI emerging markets with over an 18 trillion. So it just shows there's a little bit of a momentum effect within these indices where China's come down, India's gone up. And to John's point, there's the indices don't look at valuations or growth. And so that's where we think there's a little bit of an opportunity.
Yeah. All right, gentlemen, this has been an interesting conversation as always. I'm going to have to leave it there. That does it for this week's ETF Edge. My thanks to Brendan and to John. And we've asked John to just stick around for a few minutes and provide us with his additional thoughts on ETFs for the rest of the year and any other attractive investment opportunities he might see. That's coming up on the ETF Edge podcast. And remember, you can see all of our shows on our website. That's etfedge.cnbc.com. Everybody have a healthy, happy, and safe trading week.
Get the ABCs of ETFs with the ETF Edge newsletter. Your weekly update on the hottest trends, expert analysis, actionable ideas, and exclusive insight from host Bob Pisani. Sign up now at cnbc.com/ETF Edge newsletter.